Hello everyone, welcome to part 2 of our topic, Contingencies and Commitments. In part 1, if you have not watched it yet, stop here and go to part 1. In part 1, we build the foundation with the PRR rule and the two-step test for recording loss contingencies. Now we're going to put that practice into knowledge. We're going to work through some real-world applications. We're going to review warranty accounting, litigation scenarios, and commitments. Let's get started. Okay, so what are our learning objectives here? First, we're going to learn how to account for warranty contingencies with journal entries. We're going to analyze some litigation scenarios and apply to PRR rule. We're going to understand the difference between the commitments and contingencies. We're going to identify and account for onerous contracts. Those are the contracts we entered and we know that we are in a loss. So those special situations, there are special rules we need to apply. CPA loves to use those exceptions. And then we're going to go over to common exam traps, and I'm going to give you a couple examples to what to watch out in the exam. So we start with warranty contingencies. Think of regular warranties. You sell a product and promise to repair or replace defective products in the future. Key characteristics. It's usually probable because we know that some of our products is going to be defective. The amount is usually estimable because we know that based on the historical data, 5% of our items require warranty. So if the both conditions met, we record the warranty liability and we estimate as the percentage sale of the unit sold. So in the exam, what kind of questions you can expect? They can give you the information and they can ask you to calculate the warranty expense. They can ask you to warranty liability balance and prepare journal entries. Okay, so let's go over an example. We have a company called Electrotech, year 8. So they had 2 million sales. They have a warranty estimate. So they say based on the historical data, 3% of our sales is going to use the warranty. So this is the first year of operation. They do not have any liability. During the year, they paid $45,000 of warranty claims. And all sales are made this year, so only focus on this year. They are asking us the warranty expense, liability, and to prepare 2 journal entries. Yes, let's get started. So here is the solution, which is very straightforward, very logical. So what did it say? We made sales of 500,000. And the warranty based on previous estimates was 3%. So what is our warranty expense? 500,000 times 3%, which is 15,000. This is our warranty expense. When do we record this? We record the time of the sale. So we recognize it on the year of the sale. What is our journal entry? Debit warranty expense for $15,000 and we have a liability of $15,000. We record on year 1. What does it happen when we actually pay for that liability? We make an adjusting journal entry. We debit warranty liability and then we credit warranty expense because we already paid it. Now let's talk about the litigation contingencies. Those are the situation if there is a lawsuit against the company, and those are considered loss contingencies. What do we do here? We use the PRR rule. First, we look at the attorney's opinion. If they say if it's probable, we record it. We record it if the loss is, and we disclose the details. If it's reasonably possible, we reveal it. Remember from the PRR rule here, if it's probable, we record it. If it's reasonably possible, we reveal it. And if it's remote, we relax, we do not do anything. But of course, we have a guarantee. Let's walk through a litigation example. Our scenario, retail co. It's sued by a customer for slip and fall injury. You talk to legal counsel and they said the loss is reasonably possible. So here, let's take a pause. Remember from our PRR rule, what did they say? If it's probable, we release it. If it's reasonably possible, we reveal it, but we do not have any journal entries. And the other one, like the we relax. So here we have the second option, which is reasonably possible. We are not going to record anything, but they give us additional information. The estimated settlement amount is $2 million. The case is pending year-end. What should the retail co do in its financial statements? We apply the PRR rule. So here, reasonably possible, which is we reveal. No journal entry is required because there's no probable. If legal counsel said loss is probable, we would need that information. We disclose the nature of the contingency and the $2 million estimate in the footnotes. Here is the exemptive here. If it's reasonable possible, we disclose only. We do not record unless it's probable. Now let's shift gears and talk about commitments. So what is a commitment? Commitment is basically a future obligation from an existing contract. There is no uncertainty here. The biggest difference from contingencies. Remember, in contingencies, we don't know if it's going to happen or not. We don't know if we are going to win the lawsuit or not, or if the government is going to force us to pay for some environmental cleaning. There's uncertainty. We don't know if it's going to happen or not, and it depends on the future events. On the other hand, for the commitments, there's no uncertainty. We entered into a contract and said in the contract, if X happens, we're going to do that. So this is definitely happen, and the contract already exists. So examples here, purchase orders, construction contracts, employment contracts. And what do we do for the contracts? We do not record the contracts until we actually need to. We only disclose it in the footnotes, and when it's time to execute, we record it. So until the execution time, there is no recording. Of course, like everything, there's an example, there's an exception, onerous contracts. If we are in a contract that after we made the contract, maybe the conditions has changed, and now we know for certain that this is going to be a loss for us. We need to record it. The next slide, we're gonna go more detail. Okay, here is the exception of the contracts, which is the onerous contracts. Here you can see the definition of it. So basically, the meeting the contract obligation exceed the expected economic benefit. So what does it mean? Let me give you an example. Maybe you committed to buy inventory for, like $40 per unit. And when you enter the contract, maybe you thought you were going to make money. Then something unexpected happened. Maybe the market conditions have changed and the price dropped to $30. But you still enter a contract to purchase it for $40. So from each sale you lose $10. In a situation like that, you have to record the loss immediately. You might remember during COVID, the oil prices dropped so much, like a couple days it dropped like a negative price. So all the companies, they entered a contract to purchase oil for a certain price. They enter an onerous contract. So what are the key characteristics of this one? This is a loss-making contract. We enter this contract and we are in a loss. We are not able to avoid the contract, so we cannot cancel it. That's based on the signatures we made. We have to do our obligations. Like an example, a purchase commitment where the market price dropped below the contract price. So what do we do here? Even if it's a commitment, we record the loss here. And how do we record it? So we basically debit loss on purchase commitment, and we credit a liability purchase commitment. Each time we meet the obligation of this contract, we debit the liability to offset the balance. Let's walk through a commitment example here to see how this works in practice. Here is the scenario. We have a tech mart. Let's do it this way. We have a tech mart committed to purchase 10,000 units at $50 a unit. The contract is non-cancelable, and the market price dropped to $40 at year end, and the delivery expected next year. So for each one of them, we have a $10 loss. So we know that this is an onerous contract. So we calculate our total loss. Our loss per unit is $10, because if we did not have this contract, we could just go to free market and we could buy each item for $40. Our total loss is $100,000. So we know that this is a loss-making contract. So if this wasn't an onerous contract, if this wasn't a loss-making contract, we would only disclose it in the footnotes. We would just reveal it. But because this is a loss-making one, we record it. And how do we do the journal entry? It's like the previous example. We debit the loss on purchase commitment, which is $100,000. And we have a liability of $100,000 because of our purchase commitment. And this is an exam tip. You might see this one. I mostly see this in simulation examples. It's one of those simulation questions, like in one question you have to answer several different things, and one example is usually like that. Most of the time students say this is a commitment, so we only disclose it. We do not need to make a journal entry, but because this one is onerous contract, we have to record the loss. Okay, now let's go over the exam traps that we might see. The first one is recording the reasonably possible. Remember our PRR rule. So if it's probable, we record it. So if it starts with PR, we start recording it. And if it's reasonably possible, we reveal it. And if it's remote, we relax. So you cannot read anything there, but you got the gist. Let me clean it here. The second one is gain contingencies. For the loss contingencies, we record it if it's probable, but if it's a gain contingency, we do not record it until realize, for conservatism. If they give us a range and if they say this is more likely to this, we use the more likely one. But if they do not say more likely, which they usually do not, use the minimum of the range. If there's a guarantee, remember from the PRR rule, if something is remote, for example, we relax, we do not do anything. But whenever you see guarantee, that cancels the remoteness of the situation. We always disclose. So always disclose guarantees, even if it's remote. Confusing the commitments. So the easiest way to remember that one, if it is a commitment, it has no uncertainty. You commit, so you know it is going to happen. If you see any uncertainty, you can think of contingency, but whenever you see the certainty, you can think of the commitments. When do we record? Unless we have both conditions, we do not record in the exam. It needs to say us the situation is both probable and estimable. If either one of them is missing, we do not record it. Key takeaways from part 2. Warranties are loss contingencies because they are both probable and estimable. We know that certain number of the products we sell, they need to use the warranties. We record it at the time of sale and we adjust it when the claims are honored. Litigation applies the same PRR rule based on the attorney's opinion. Commitments have no uncertainty. If it's a commitment, you can think of there's a contract exists. Onerous contracts are exception. Maybe I say this one. I remember if there is a contract, we only reveal it. But if it's an onerous contract, we also record it because we know that we're gonna lose money. So it requires loss accrual. And we disclose the commitments in footnotes. The warranty formula is sales times the percentage of the warranty, which is the expense. For the litigation clue, it's mostly in simulations. You might have several letters and look for the attorney's opinion. If you see a question like that, start with the attorney's opinion because, like it would usually tell you if it's probable, reasonably possible. So you can decide what to do. For commitment, we know if it's certain, if it's a contingency, if it is contingent upon something uncertain. If it's onerous, we know it is going to be a loss. Okay, so we are in the end of part 2. We covered the warranty accounting, we did some journal entries, some litigation scenarios. We saw the difference between commitment and contingencies, and examples of onerous contracts and when to record. Now let's go into part 3. We are going to do some additional questions and you will see some IFRS and GAAP comparison. Thanks.